Okay, so this next video, this is the second video in the series where we're talking about the intersection of estate planning and crypto. And now we're going to get into some of the tax issues that we run into with crypto assets. In the first video, we talked about just kind of the general landscape of crypto. We talked about where clients are kind of getting into this space, and we started taking a look at just some of the mainstreaming, if you will, of clients into crypto. We also talked a little bit about the landscape of different types of crypto, looking at what I refer to as commodity tokens like Bitcoin versus stable tokens like USDC or Tether versus DeFi tokens and non-fungible tokens. So um, go back and watch the very first video in this series if you're interested in that information. But now we're going to talk about some of the tax issues that we have to think about in the context of estate planning with crypto assets. Really, the only clear pronouncement that we've seen come out of the IRS so far is IRS Notice 2014-21. And it's important, it's worth pointing out that 2014, it's like 100 years ago in the crypto space. In 2014, I don't think anybody was really even thinking about decentralized finance and lending and staking and voting rights and things like that. Non-fungible tokens were probably an idea, but certainly were not part of the mainstream dialogue in crypto. This notice applies to convertible virtual currencies, and it does specifically call out Bitcoin. But I think it's reasonable to assume that the general provisions of this notice apply to the entire crypto space. So, where the virtual currency that's being used, they use the term currency as opposed to asset. There's some nuances there, but I think again, for purposes of our conversation here, whether it's an asset like Bitcoin, whether it's a currency like a stable token, it looks at any digital asset that has an equivalent value in real dollars or acts as a proxy for real currency. I think this is probably an irrelevant point as to the stable tokens because, as we talked about in the first video with the stable token, where the value of the token is 1-to-1 with the dollar, where one USDT or one GUSD token is equal to one US dollar. You're not going to have gain or loss. So, but if we're dealing with tokens that are not pegged to the value of the dollar, but whose price is volatile and fluctuates over time, or where there's a market for markup or markdown, the long story short is that those assets will be taxed as property. And so it's in many respects, it's like any other property like Apple stock or Tesla stock or something like that. So when value is received, when I get paid, for example, in Bitcoin, IRS Notice 2014-21 tells me that when I get paid in Bitcoin, the equivalent value in terms of US dollars is taxed as ordinary income to me. Even if I don't liquidate it, which I don't do, by the way, even if I just receive it, the value that I receive in US dollar terms is ordinary income to me. But it's not a currency. It's not legal tender in the United States. And so it's like I got paid in a capital asset. Again, it's like I got paid in Apple stock. So the value of that asset received is income to me, and now it is subject to my holding period for purposes of capital gains tax purposes. So crypto assets are capital assets for individuals when those assets are traded from Bitcoin to another crypto asset, for example, or when they're liquidated going into a US dollar or potentially going into a stable token or something like that, that becomes a capital asset subject to capital gains or subject to capital loss. Now, so again, kind of recapping, a taxpayer who's going to receive virtual currency as a payment for goods or services has to include the fair market value of the virtual currency as measured in US dollars as of the date that currency was received. And the beautiful thing about crypto is that the transaction timestamp is a permanent record of the blockchain. So we know exactly when a transaction was confirmed, substantiating the transaction time in addition to just the date. So we know exactly when Bitcoin hits my wallet, for example. And so we know that the value of Bitcoin, when received, is income to me. Now, the basis of that virtual currency that a taxpayer receives is going to be the fair market value in US dollars at the time of receipt. So again, I mark it as ordinary income, pay income taxes on that, and at that moment, it marks the beginning of my holding period at the US dollar value. Now, assuming that I'm not in the business of exchanging crypto, the crypto is not inventory for me, it's a capital asset. And so therefore, when I later liquidate my Bitcoin, it will be subject to capital gains tax or subject to a capital loss, and the rate is going to depend on my holding period. If I've held that for less than 1 year, it's going to be subject to capital gains tax at my ordinary income tax rate. If I've held it for a year or longer, it then becomes subject to long-term capital gains tax rates. The IRS notice did specifically address hard forks and airdrops. And it really kind of drew the line at where the taxpayer has what the notice refers to as an accession to wealth. If you have control over the crypto asset and you then have the freedom to liquidate it, then that asset constitutes income for purposes of the IRS notice. If it's subject to some type of lockup and you don't have the ability to liquidate it, then it's not treated as income until you have the ability to dispose of it. The interesting thing here too is that, again, in the prior video we talked about airdrops just kind of generally as where this wealth sometimes comes from. I mentioned the fact that social media influencers and some people who are personalities in the crypto space will often wake up finding these mysterious tokens now in their wallet through what's called an airdrop. They don't have to know about it. They don't even have to want it. But if they have received airdropped tokens that they can now freely dispose of, that airdrop constitutes income. And if you think about this, it kind of makes sense in the context of our estate planning. We've known for a long time that we can cause estate tax inclusion for somebody else simply by granting them a general power of appointment over assets inside of a trust. And again, a general power of appointment, that's probably a conversation for another time. If you don't know what that is, maybe I'll do a video on that specifically. But in essence, if you have a general power of appointment, a power to direct property in favor of yourself, your estate, your creditors, or the creditors of your estate, any one of those four permissible appointees will cause the value of the property over which you have that power to appoint. It will cause the value of that property to be includable in your estate for federal gift and estate tax purposes. And so we'll do this intentionally from time to time. We'll grant a general power of appointment to a beneficiary, for example, to cause a basis adjustment when that beneficiary passes away, and can allow us to allocate their gift, estate, and generation skipping transfer tax exemptions to the property or to the value of the property over which they've got that power of appointment. Really cool strategy, but understand that from the estate planner's context, getting an airdrop in your crypto asset wallet is just like having a general power of appointment over a trust that you didn't even know you had. A beneficiary doesn't have to know that they have a general power of appointment for that power to cause estate tax inclusion. The same thing is true with airdrops. You don't even have to want or even know that you got tokens airdropped to you for tax liability to arise. It's worth pointing out that the Treasury Department is openly sharpening its focus on crypto assets. There was a pretty well-known John Doe summons issued in 2016 where the IRS forced Coinbase to provide information on about 13,000 of their account holders who had more than $20,000 in transactions over the course of a given tax year. Now, back in 2016, $20,000 was kind of a lot of money in the crypto space. Now, in 2021, $20,000 could easily be a single transaction. But that John Doe summons in 2016 caused over 1,000 amended returns, and for the IRS collected over $25 million in additional taxes, notices, and settlements from taxpayers. Here in 2021, at the time of this recording, it's June of 2021, two other exchanges, Kraken and Poloniex, have summonses pending, where the IRS is on a similar fishing expedition looking for account holder information from those exchanges because they believe that a significant number of crypto asset transactions are being unreported, and therefore there's a lot of tax liability out there to be collected. There's a new question that arose on the 2020 individual income tax return, where right there in the middle of the first page on the Form 1040, there's a question that says, at any time during 2020, did you, the taxpayer, receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? Now, in the question and answer, in the Q&A section of the notices that the IRS put out, they clarified that that does not contemplate if you simply went to an exchange and purchased Bitcoin, for example. But when we receive crypto as compensation, we have to answer yes to this. If we trade, we have to answer yes to this. If we liquidate, we have to answer yes to this. And so the IRS is seeking to hoover up as much information as they can around crypto so they can start to understand how many taxpayers are involved. And I suspect that there's going to be a continued enforcement actions taken around crypto. There's another case that's currently pending in the U.S. District Court in the Middle District of Tennessee, a case that is around the project called Tezos. Tezos is part of the DeFi. It's one of the crypto asset tokens involved in the DeFi space. And so it's what's called a staking protocol, where often the holder of Tezos will pledge back the Tezos tokens to the network for purposes of fueling, if you will, the network activity. And so these types of tokens generate a yield, and the taxpayers in this case reported income from staking activities and then filed an appeal to the IRS. And so now they're suing the IRS for a refund on the income taxes that they paid on the tokens they received through their staking activities on the blockchain. And again, we talked about the IRS pronouncement 2041-21 did not address DeFi, did not address staking, because these concepts they just weren't kind of a thing back in 2014. So there's no pronouncement from the IRS on how they're going to address this. The key issue really at stake in the Tezos case is, when is the value created and when is it received by the taxpayer? Core of the issue here is, did the taxpayers' staking activity by pledging their tokens back to the blockchain, did that create new property? Or did they receive property of value from the activity? If so, is that taxable? So the taxpayers, I think, wisely claimed it as income, but now they're suing for a refund to get clarity around this issue. Here again, in midsummer of 2021, this is unresolved. So here are some of the tax planning considerations that we just need to have top of mind. First, remember, income is going to be measured as income, ordinary income, when it's received in exchange for goods and services. It is treated as a capital asset unless there's an inventory exception, which it won't be for most people. It's treated as a capital asset subject to capital gains tax rules, subject to holding periods and rates. Now, this starts to kind of open up some thought for us in the context of sophisticated estate planning. So, are there ways that we can establish ownership of the crypto in a tax favored structure? We're going to look at it in some of our case studies. We're going to look at some strategies that we've put into motion from an estate planning perspective on how we sever dominion and control. This also then opens up the opportunity for some advanced strategy options like completed gift trusts, where the taxpayer can transfer crypto assets out of their estate for federal gift and estate tax purposes using their estate tax exemption to get the value of the crypto out of their estate now, so where it can grow in an environment that will then escape estate tax or generation skipping transfer tax, regardless of how big that asset gets. So we'll talk about what we've done in a couple of specific client cases to address that. This also opens up the opportunity for irrevocable non-grantor trusts, where the trust itself becomes a separate federal income tax payer, where if you're a client in a high income tax jurisdiction from a state, like a state income tax jurisdiction, where we can establish a taxpayer trust in another jurisdiction, such as Wyoming, where future income taxable events can at least escape state level income tax. And we'll also talk about some of the strategies that we're doing in the context of philanthropic planning, where crypto may provide a really interesting solution in charitable trusts. So that's just a really quick overview of some of the tax issues that we're thinking about in the estate planning context.